Alan, let me begin with you a little bit. The tariff situation and the surprise that it's not just that August 1st is a tariff deadline, but also a new rate to contend with and maybe 6 more days to get adjusted to that. What's your take?
I think right now it's a bit of Groundhog Day in terms of you wake up, you get a new set of circumstances, and the market tries to react and work through it. Our hope is that we will see something akin to what we saw with Japan, the Eurozone, and South Korea in the coming days, whether it be with Mexico or even a negotiation on Canada in terms of getting down from the 35%. So our hope is it will get to a better spot. And in the interim, companies are going to continue to try to navigate through that and ensure that they don't bear the full brunt of some of these new costs.
You know, it's interesting because we did see the Tokyo Stock Exchange jump when the deal was announced, and yet this morning across Asia, you're seeing the indices lower on the day. Same for Europe. Keith, when you're looking at how this plays out on the global economic front, this is a real reordering of the trade balance.
Yeah, well, good morning. Great to be with you and great to be with Alan as well. It is true, but we've been dealing with this all year long. I think the other thing to keep in mind for this market as we see it in the red today, I mean, we're up 28% off the lows, and the market has been somewhat vulnerable to bad news. And there's some uncertainty as we head into this seasonal weak period of August, September. We still have to work through this tariff uncertainty. So I think it makes sense that the market pulls back a little bit here. But I also think it's important for investors to not overreact, as we are reminded back in April that the markets can rebound on also good news as we get some of these deals put in as well. But I do think we're going to have more of a choppy period as we move into the seasonally weak period with high expectations. So I think markets are just going to have to digest and consolidate the gains and kind of wait for more clarity on the tariff front in order to move higher, which I think will be later in the year.
We'll get the jobs report at 8:30 Eastern time this morning. We heard Jerome Powell say in his post-Fed decision news conference that, look, the job market is stable, but there are factors that could disrupt that in the months to come. Alan, when you're looking at jobs and the domestic economic situation, do you have cause for concern, or do you think that we're in a period of smooth sailing?
I think it's going to be similar to what Keith outlined, which is more volatility. As you think about the job situation, what we've seen is that older workers are actually in pretty good shape right now. Younger workers, on the other hand, have felt some stress and have not been able to capitalize on a really strong job and employment environment in the United States. And so we think it's going to be a little harder. And it's certainly difficult for the Fed, given this almost binary outcome for the older versus the younger workers in terms of discerning that. In addition, I think the immigration policy is going to come up even more over the next couple of months, specifically for industries like hospitality, real estate, and broadly speaking, agriculture.
It's clear that the big bets on AI are being rewarded by Wall Street right now. If you look, Keith, at what we're seeing with Apple, with Amazon, with Meta, with Alphabet, talking about their big investments in AI, is technology still the place to be?
We still like technology. The big underlying theme of this bull market has been AI and tech, and we call it the big T. I mean, there's tariffs and the other T, which is technology. Earlier this year, the AI theme got pushed to the back because of tariffs, so we're seeing that again. But I would not lose sight, because even if the economy slows, even if we have more tariffs, the underlying secular themes for tech are still positive. That's the biggest part of the market. Now, on a short-term basis, tech is also a little bit extended as well. But on any kind of pullback during the summer volatility, we would look to add to that area and stay overweight tech, communication services, and also in industrials, because that's where the earning trends are the strongest in the market.
And why is consolidation your word of the day?
Because even before the tariff news, we've gone up. The market has been pricing a lot of good news. And, as an example, when the market made a low back in April, it was baking in about 60% of recession risk, right? So that was saying a lot of bad news was priced in. Now it's down to 10%. So you're vulnerable to any kind of bad news on a short-term basis. I think we have to digest these gains, maybe pull back a little bit more, and just kind of, digest these big gains that we've had through the seasonally weak period.